This is SABARI Krishnan from SABARI Securities. Welcome to Option Unlocking Series 1. In this series, we have 5 chapters. The chapter 1 will discuss about the concept of options trading and the difference between option buying and option selling. The chapter 2 will discuss about call and put option. Chapter 3 will discuss in detail about the concepts available in option chain charts. Chapter 4 will deep dive and discuss about the concept of option payoff diagrams. And Chapter 5 will discuss about the concept of hedging. Today we will begin with Chapter 1. Options trading is simply an auction that takes place between a buyer and a seller on a specific securities product. This product could be a stock or an index. Example of a stock is Reliance or HDFC Bank or SBI. An example of an index could be a Nifty or a Bank Nifty. Once the price is agreed upon between the buyer and seller, then they get into a contract with a time value. This time value is an expiry date on or before the trade has to be closed and profits has to be booked. Keep it as simple as possible. We have an option buyer, option seller. They get into an auction on a securities product like a stock option or an index option. And once they agreed upon the price and the trade gets initiated, they have to close the trade and book profits before an expiry date. Let's see and understand the basic difference between the equity markets and options trading. In equity, an investor can buy a stock at the current market price and he can hold the stock for an indefinite period of time. And then later point of time, he can sell the stock at a desired target price to book profits. In equity, an investor would like to buy HDFC Bank shares of 500 quantity at current market price, which is trading at 1000 rupees. Now what will be his investment here? 500 shares into 1000 rupees per share will become 5 lakhs. Point number 2 is the investor can hold the stock for an indefinite period of time as there is no expiry date. Now, whereas in options, every stock will be assigned premium value. Let's say in this example, a trader wants to buy the same HDFC Bank stock option of 500 quantity. He can buy the same stock option at a premium value, not at the market value. Let's say the premium value of HDFC Bank is 50 rupees. Now in this case, the capital will be 500 shares into 50 rupees premium per share will be 25,000. So the biggest advantage for a trader is the trader can buy the HDFC Bank stock option with a less capital compared to the equity market. Now point number 2 is once the trader has bought the stock option, he has to sell the stock option for a profit or a loss on or before the expiry date. Fundamental difference is in equity market you need more capital, in options you need less capital, and in equity there is no expiry date, and in options there is an expiry date on or before which the transaction has to be completed. Now we will understand the difference between option buying and option selling. I would like to give you a real world example with regards to real estate. So let's say we have a seller who is willing to sell his house for 1 crore. And there is a buyer who's willing to lock this deal with the seller. So typically what happens, a seller gives a timeline to the buyer. Let's say in our example, 3 months, which means on or before this expiry date, let's say 30th March, the registration of this house has to be completed. To lock this deal, the seller gets an advance from the buyer, which is 10 lakhs. Once the advance amount has been transferred from buyer to seller, buyer has the right to register this house at any given point of time on or before 30th March, which is the expiry date. Let's say on the day of expiry, if the value of the house increases by 10%. So let's say it becomes 1 crore 10 lakhs. In this case, the registration of the house will still take place for the agreed value of 1 crore. And since the value of the underlying asset, which is the house, has increased by 10%, has become 1 crore 10 lakhs, the buyer makes a profit of 10 lakhs and the seller will lose 10 lakhs. Let's say on the day of expiry, on March 30th, which is our expiry date, if the value of the house decreases by 10%, let's say it becomes 90 lakhs, then still the registration will take place for the agreed value of 1 crore. And since the seller had sold the property for 1 crore, which is of 90 lakhs value as on expiry date, the seller would be making a profit of 10 lakhs and the buyer will lose 10 lakhs. Seller will make a profit of 10 lakhs and the buyer will lose 10 lakhs. So the key concept here is when the value of the underlying asset increases, the buyer will make a profit, and when the value of the underlying asset decreases, the seller will make a profit. This is a very key point that you have to keep in mind before we move to the next section. Okay, now coming back to our options, let's say we have an option buyer, option seller. The product in the auction is, let's say, HDFC Bank. Now, as I said in the previous example, in options, every stock is assigned a premium value. Let's say in our case, the premium of HDFC Bank is 50 rupees. So the option seller is willing to sell HDFC Bank to an option buyer at a premium of 50 rupees. The buyer is willing to pay the premium of 50 to seller and he collects the option. Now once this transaction is initiated, now the buyer will expect the price of the HDFC Bank to move higher. Let's say it is trading at 1000 rupees and you will expect the price to move higher, so that when the price becomes 1050, the premium value what he has bought will also increase to say 100 rupees. Now in this scenario, the option buyer makes a profit of 50 rupees. Right. Now what is the maximum loss he can make? Let's say the 50 rupees can become 0, right? So the maximum loss is 50 rupees. But on the other side, if the price of the HDFC Bank keeps moving higher and higher, the premiums can keep on moving higher. So eventually you will make unlimited profit, right? So in option buying, there is a limited loss and unlimited profit. Since there is a limited loss, there is no fear, correct? And since there is an unlimited profit, there is always more greed. Let's take another example. Let's say we have an option buyer, option seller, and the product in the auction is Axis Bank. Let's say Axis Bank is trading at a premium of 100 rupees. An option seller is willing to sell Axis Bank option for 100 rupees to a buyer, and the buyer pays the premium of 100 to the seller. The seller collects the premium and the transaction gets initiated between the buyer and seller. Now in this case, the seller would always expect the price of the Axis Bank to move down, right? So that, let's say if the price of the Axis Bank is 700 rupees, and from 700 the price starts to move down to 650, the premium what he sold, the 100 rupees premium, will also decrease, let's say by 30 points. Let's say it becomes 70. Now he can go ahead and buy back the same option what he sold for 70 rupees, and he books a profit for 30 rupees, right? Simple. Now in option selling, since he had sold an option for 100 rupees, for that option to become profitable, it has to decrease. Now, what is the maximum value it can go down? It can go down to 0, right? So the premium what an option seller sells will be his maximum profit, because the maximum value it can go down is 0, right? So in option selling, there is always a limited profit. But if the price of the Axis Bank starts to move higher, the premium from 100 also will shoot up, and it can rise as per the movement of Axis Bank price. Now in this case, we will have unlimited loss. So since there is a limited profit, there is no greed. And since there is an unlimited loss, there is more fear. So to summarize chapter 1, every stock or an index option will be assigned a premium value. An option buyer would always buy a stock or an index option at a lower premium, and we would expect the price to increase so that you can book the option at a higher premium and make profits. An option seller would always sell a stock or an index option at a higher premium, expecting the price to fall so that the premiums will also decrease, and you can later buy back at lower premium to book profits. In option buying, there is a limited loss and unlimited profit. So there is no fear and more greed. In option selling, there is a limited profit and unlimited loss. So here there is no greed and more fear. Now there is an expiry date on or before which both option buyer and seller has to close the transaction. For stock option, there is a monthly expiry, which is last Thursday of every month. Now for index option, there's both weekly expiry and monthly expiry. Weekly expiry is Thursday of every week, and monthly expiry is the last Thursday of the month, like stock option. So now I will explain how option buying and selling works, the live trade. If you look at my net position, the first option where I have sold a Nifty option for 1000 quantity, that is why in the quantity it is showing minus 1000 for a premium of 174.05, and now the current premium is 174.50. So as I mentioned, for option selling, the premiums have to decrease, right? Here the premium has increased a bit by 45 pies. So since I had sold for 1000 quantity, I am in a loss of 450. In second option, where I've bought 1000 quantity of Nifty at a premium of 138, and the current price is 138.20. And since the premium has increased by 20 pies, the overall profit is 200. So now hope you understood the difference between option buying and option selling. Thank you for watching and keep looking forward to chapter 2.